What is an estate tax? An estate tax is based on the value of your assets when you die. So taxing the value of your assets when you die. So if you die with too much money, you might end up having to pay some of that money to the government. So just add another tax to the list, please. Thank you. Now, this episode relates specifically to Washington State, which is where I practice. Washington is one of a handful of states that has its own state-sponsored estate tax. 12 states plus the District of Columbia, whatever that is. I know what it is, but it just seems very odd that has its own to me. Has estate tax.
You are listening to the Legacy Talk podcast hosted by James A. Jones,
attorney at law and founder of Sound Legacy Law, PLLC in Tacoma.
Attorney Jones is here to talk about how to best protect your family, assets, and wealth. Pulling stories from his more than 20 years of helping families and business owners protect their assets, create their estate plans, preserve their wealth, and plan for the future. Nobody wants to think about estate planning, but life has a way of sneaking up on you, and at any moment, something unexpected could happen that will leave you regretting not having acted sooner. So join Attorney James A. Jones in the Legacy Talk podcast, and together learn how to plan for your future today and have peace of mind tomorrow.
Welcome to Legacy Talk. I'm your host, James Jones. I'm an estate planning and probate attorney in Tacoma, Washington. I've been practicing for over 20 years, and my main practice areas include estate planning, probate, and estate administration. On Legacy Talk, we discuss topics surrounding families and estates. Estate planning is often a confusing and complicated topic, but my goal with this podcast is to make it understandable and accessible to those who need it. So if this is something that interests you, I'd appreciate it if you click the subscribe button and like this episode so that you can follow along as we break down the barriers to estate planning. As always, I'm excited to get to today's topic. Seems like I'm always excited for the daily topic. Today's topic is the estate tax threshold. When should you start planning for estate taxes? Because failing to adequately plan for estate taxes can have significant consequences to your estate, particularly money-wise. So, on today's show, we're talking about the estate tax threshold, when you should start planning for estate taxes. So let's get to it. Nobody wants to pay taxes, right? At least most people don't. By the time we die, most of our money that we earn or receive will have been taxed multiple times. We pay income tax, we pay sales tax, capital gains, we pay excise tax on cars or real estate, etc. One tax that we don't often consider, though, is the estate tax. And many people, this is a misunderstood kind of a tax because it doesn't apply to everybody, but in Washington, it applies to more and more people than you would think. What is an estate tax? An estate tax is based on the value of your assets when you die. So taxing the value of your assets when you die. So if you die with too much money, you might end up having to pay some of that money to the government. So just add another tax to the list, please. Thank you. Now, this episode relates specifically to Washington State, which is where I practice. Washington is one of a handful of states that has its own state-sponsored estate tax. 12 states plus the District of Columbia, whatever that is. I know what it is, but it just seems very odd that has its own to me. Has estate tax. That's an aside, maybe. Washington and Hawaii have the highest top rate of 20%, which is high. Oregon has the lowest exemption of just $1 million. So anything over $1 million in Oregon is subject to estate tax. But Washington also has a low exemption, which we'll get into in a second. So we have a high tax, the highest rate, tied with Hawaii, also one of the lowest exemption levels. So on today's episode, we're going to talk about and go over what you need to know to effectively plan to reduce, mitigate, eliminate estate taxes and plan around the estate tax exemption. So what is Washington's estate tax threshold? So I'll stop here for a second, okay? So when there's an estate tax, typically there's a number below which you don't have to pay tax. If you pass with funds or money or estate value below a certain number, you don't have to pay any tax, okay? So Washington State's estate tax applies only to estates valued over $2.193 million as of this year, 2024. This is in contrast to the federal exemption, which has a much higher estate tax exemption, which is $13.61 million as we speak. This relatively low estate tax threshold in Washington means that a significant number of estates here in Washington should be planning for and are planning for and could be subject to the estate tax, even though they fall well below what the federal exemption is. We don't usually worry about the federal as much as we once did because it's such a high exemption. 13.6 million is a lot of money. And if it's a married couple, that's 27 million plus. Washington, so what that means, I guess, the threshold is 2.193. If you have less than 2.193, you don't pay estate tax, okay? But if you have more, even $1 more, you're subject to paying estate tax and filing an estate tax return, which is a disaster we've talked about before on this podcast. The tax rate that we're talking about here is between 10 to 20%, depending on the size of the estate. In Washington, the first $1 million over the estate tax threshold of 2.193 million is taxed at 10%. So the first $1 million is $100,000, okay? And that rate increases up to 20% for estates valued around $9 million, okay? So the farther up we get, the more percentage we're paying, okay? And so for high net worth individuals, or even, as we've talked about on this podcast, people that have had regular jobs, middle class jobs, that have had a house and they've saved well in their 401k, they've paid down their mortgage. Real estate values in Washington are very high and they've gone up a lot. And so people's houses are worth a lot more than they think. Their 401ks are doing well, ideally, and they're at that estate tax threshold more often than not. So this impacts businesses. This impacts small businesses in particular, real estate owners, so it's essential to recognize even moderately, people that say, well, I'm not rich, I don't have enough money to worry about the estate tax. You might. If you're even thinking about it, you probably do. So how do we prevent this? First thing to do with regard to our estate tax planning is to start to plan, okay? Early planning matters. Estate planning is essential to help mitigate and potentially eliminate the estate tax. And so early planning is the most effective, ideally, because then you can put a plan in place that helps you over time make sure that you are under that exemption level. You want to mitigate surprises that come out. Without proper planning, heirs can face unexpected tax burdens and bills that require liquidation of assets like businesses or real estate holdings or stock portfolios to pay the tax. And I've got a story coming up that talks about this, okay? Early planning prevents the estate from having to make drastic changes just to get under the estate tax, okay, to minimize that tax burden. And then early planning also allows you to have long-term strategies to employ sophisticated strategies in order to reduce the value of your estate over time through gifting, through trusts, restructuring ownership, things like that, okay? So early planning is key. I guess back up. Planning is key. Early planning is ideal. Long-term planning is then possible through early planning. One strategy that we can use in dealing with the estate tax is gifting. Lifetime gifting can significantly reduce the size of your taxable estate. That means this asset that I have is worth too much in my estate, right? If I give it to somebody else, one of my kids or something like that, or a trust for one of my kids, I remove that asset from my estate. So by gifting assets during your lifetime, you can move wealth out of your estate, potentially bringing it below Washington State's estate tax threshold. The great thing about Washington, other than the natural beauty and the weather's pretty good, no comment on the rain, it's not as bad as you think. There's no state gift tax in Washington. So you can make any kind of gift in Washington without worrying about a state-sponsored gift tax. So there's a 2.193 million exemption for estate tax. There's no worry about the gift, though. There is a federal gift tax, which is the same as the federal estate tax exemption, which is at 13.6 million. If you're under that, you're not really worried about it, right? So most people aren't worried about that 13.6, so they have free reign to gift basically everything. There's pros and cons to gifting, and we've gone over that. You don't get a stepped-up basis. There's issues. What happens if the kid gets divorced or gets sued or something like that? So there's issues to consider on gifting, but it is a possibility and is sometimes used as a good strategy to reduce your taxable estate. If you're worried about the federal exemption too, there's an annual exclusion from the federal gift tax, which is $18,000 per person per year, where you can gift any recipient $18,000 annually. So if it's a married couple, that's $36,000 without impacting the federal exemption. So larger gifts potentially can require a federal estate or gift tax return, but if they keep them small, it doesn't matter as much. The other thing to consider, next thing to consider, so we're talked about planning, we talked about gifting. The next thing to consider is utilizing trusts for tax efficiency. So if you're a married couple, the use of a credit shelter trust or a bypass trust or a qualified terminal interest property trust, which is sometimes called a Q-tip trust or mostly called a Q-tip trust, can be powerful tools in mitigating estate taxes. The credit shelter trust, for example, holds up to the amount of the estate tax exemption to ensure that it's not included as part of the surviving spouse's estate. So a credit shelter trust is used in conjunction with a joint revocable trust typically. It can be used in a will. It can be used in a single trust as long as you're married. You can exempt that amount for your spouse. Okay. And so that amount, if you have a $4 million estate and you put up to $2 million in the exempt trust, that credit shelter trust, and the surviving spouse has $2 million in his or her name, then ideally you don't pay estate tax, right? And you've sheltered $2 million. And then you shelter another $2 million through the exemption of the surviving spouse. These types of trusts can provide various benefits, including protecting the assets from creditors. So these credit shelter trusts protect the assets from creditors as well as keeping them out of the taxable estate. They can also control how beneficiaries use the assets. So if you want to make sure that your surviving spouse, if it's a second marriage or something like that, if they're not going to blow all the money and if there's anything left, it goes to your kids. Oftentimes that's very popular. And so trust can be variable for that. And then there's flexibility in planning with the trust, allowing you to set specific conditions for distributions and make sure that things that you've worked hard for are used for the things you want them to be used for after you're gone. Number 5 thing to consider with regard to estate planning is portability and spousal exemptions. When you're a married couple, there's an unlimited marital deduction. So if I died with $1 billion, I could give $1 billion to my wife and she wouldn't have to pay any estate tax on that. The problem is that $1 billion would be taxable later in her estate minus $2.193 million if we're still living here in Washington, which we probably would be. There's a problem in Washington where if you don't use that exemption, if you don't shelter your exemption when you die, you lose it. That's called portability. Unlike federal law, which allows for the transfer of any unused portion of the estate tax exemption to a surviving spouse, portability, Washington state does not have portability. So you can't say, well, I've only used $1 million of my exemption, so I want to give the other $1.193 million to my spouse so that they can use it. That's not a thing. So if you don't use the full exemption, you lose it. If you don't shelter the exemption when you die, it's gone. So if it's not properly planned, you could lose the first spouse to die's exemption at death. And so planning for couples should consider the use of credit shelter trust, like we just talked about, also known as a bypass trust, to ensure that both spouses' estates exemptions are used. This definitely reduces and could eliminate taxes. Washington's also a community property state, so we want to make sure that we're considering community property issues when we're planning, right? If we're retitling things, we want to make sure that they're titled properly so that the full exemption can be used in the credit shelter trust or the Q-tip trust or whatever. Number 6 thing to consider is annual exclusion gifts. We talked a little bit about the annual exclusion. You can gift $18,000 per person per year without incurring taxes and without decreasing your federal exemption. In Washington, this can effectively reduce your estate. And so by making these gifts, you can give $36,000 per year, which we talked about. And you can include grandkids, you can include friends, you can include spouses. There's ways to set up trusts to maximize the amount you can gift. So you can really increase the giftable amount, which has a significant impact. Another thing that's pretty complicated, but it's a cool strategy, is something called a valuation discount. And this is typically for business owners, but you don't have to necessarily have a business to get this. For owners of closely held businesses, valuation discounts for things like lack of marketability or lack of control or minority interests can be applied to reduce the value of that asset, business entity, for estate tax purposes. These discounts reduce the appraised value of the business, which in return reduces the value of the estate. And so you can, say, create an LLC, a family limited liability company, and get it appraised and get an appraiser that would discount it maybe 10 to 15%. It used to be higher than that in the old days, but now they're not quite as accepting of that. But one thing that's very popular to do is to create an entity which holds family asset that you can gift over time. So you can gift ownership interest in an LLC, like shares of stock, to your children, or a trust for your children, where you're really not giving them control of the asset. You're really not giving up the asset. You're really not even giving up the benefit of the asset, but you're moving the asset out of your estate. And so that's one of the things where a long-term strategy is critical, because you can't do it all at once. You want to do it under the annual exclusion typically. The other thing to consider is charitable giving. We've talked about charitable giving a lot on this podcast, but you can significantly reduce your estate or estate tax burden through charitable giving. Charitable giving during your lifetime reduces your estate at the end. You can also reduce the value of your estate or gain deduction through charitable bequests. So charitable bequests made at death are dollar for dollar deduction against your estate value. And so this is particularly beneficial in a state like Washington with such a low exemption. And so the benefit of these charitable contributions would be that you're getting potentially an income deduction during your lifetime for making charitable bequests if you make them during your lifetime. And then if you make them at death, you get that deduction for your estate value. You can also create your own charity. Things like donor advised funds, private foundations, charitable trusts. You can create your own charity that allow you to make significant charitable contributions but retain some control of how these funds are used. They provide immediate tax benefits, making them flexible options for estate planning. I've got a little story about this coming up. Now, mainly we're talking about the Washington state estate tax because that's where we are, and that's the low one. But we want to make sure that we're keeping things in check with the federal exemption too. If you're creeping up on that $13 million number, which also with the value of assets nowadays and things like that is possible. So we want to coordinate our efforts between both exemptions and maximizing both. And so careful planning is needed to do that. So we often use balancing strategies to consider the interplay between state and federal taxes, ensuring that strategies to reduce one do not negatively impact the other. So if you're making massive gifts to get out of the Washington estate tax, but turns out you have a potentially taxable estate at the federal level, then you might be eating into your federal exemption, because if you make gifts against the federal exemption during your lifetime, you're eating away at the federal exemption. So we want to make sure that we're balancing these approaches. Okay. And then, like every estate plan that you have, review the thing. And so I've talked about this before on this podcast, when I started doing estate planning or learning about estate planning, right when I started, the exemption level was at the federal level was $600,000. And so that's very low, right? And so these things change. Throughout my career, it's gone from 6 million to 600,000 to 5 million to $1 million to 10 million to no estate tax to $1 million to 2.5. It goes up and down at the federal level. And so you got to watch it. You got to look at it once in a while. And so having a relationship with a good estate planning attorney that's on top of those things and that you're actively working with regard to estate tax strategies is critical. You also want to make sure that you're checking your value of your house. Check the value of your 401k. Make sure you're looking at your brokerage accounts. Did you forget that you have that life insurance? Life insurance counts against your taxable estate. So look at what you've got. Okay. So this leads us to our story time. I've got a few stories here. The first one is about a small business here in Washington. It's a very successful business, and it's been in business a long time, and its value was over $10 million. So in Washington, there's an estate tax. The owner of the business had no estate planning done, and the business had an asset owned by the business, which was a piece of real estate. No estate tax planning was done, not even a will. There's nothing. It's really not great. And so that estate is going to end up paying significant estate taxes. They're probably going to pay capital gains taxes, and they're basically eating into this estate. They've got a massive estate tax bill there, through no planning. If things were planned properly and they would have talked to an estate planning attorney before dying, this could have all been prevented. There's significant issues. So early planning matters. Failure to plan means a few $1 million out of the pocket of the children. Okay. The second story is about a guy that I just met recently. Single man, no children. He has a $5.5 million estate. And in this estate, he really doesn't know what he wants to do with it. In our meeting, he didn't realize that there's an estate tax in the state of Washington. He hadn't heard of that. So he was thinking, well, how do I get rid of my estate? Who do I give it to? And the strategies that he was considering didn't have anything to do with the estate tax. And so we discussed creating trust, creating potentially a foundation for charitable bequests that can sort of be controlled when he's gone, to reduce the value of his estate, get some deductions against his estate tax, which should allow him to reduce strategies. And even though he's an older guy, doing this can have a significant impact. So though it's better to plan early and have a long-term strategy based on a early planning goal of reducing these taxes, doing something's better than nothing. Okay. And then the third story is someone I meet with all the time. My typical client is a married couple that I talk about all the time. They have a house worth maybe $1 million. They've got 401ks in the 500s, maybe in the $1 million range, right? They probably have some life insurance. They've got some personal savings. They've got a brokerage account, after-tax money. Their estate may be worth 3, 4, 5 million, and they're not even considering it, right? Because it's in their 401k and they don't look at it. Or they get this life insurance through work and they don't look at it, right? Or their house has gone up so much and they didn't realize it. And so for a couple like that, an A-B trust with a credit shelter trust to shelter the first spouse's exemption who dies can really solve their problem with estate tax. It doesn't only solve the estate tax problem, but as we've talked about on this podcast ad nauseum, is it would also avoid probate because it's in a trust. And so the solution's easy, right? For a married couple, like most people that don't have a taxable estate or they have a $4 or $5 million estate, it's easy to get out of the estate tax in Washington with planning. Larger estates are more complicated, but those also have options. So planning is key. Being aware of it is key. Considering it, right? Just think about it, right? So just think about it, man. Anyway, so that's the episode today. No, nothing good today in the episode. I'm not talking about something good in the news today, so that's it. That's what we've got for you. Anyway, thanks for listening to today's episode of Legacy Talk. If you liked today's episode and would like to learn more, please like and subscribe for more great content. I've been your host, James Jones. To your legacy.
Thank you for listening to the Legacy Talk podcast by attorney James A. Jones. If you found today's episode helpful, we ask that you like and follow us on all major platforms so you don't miss out on the latest episode. If you have questions for Attorney Jones, reach out at info@joneslegacylaw.com or visit our website at joneslegacylaw.com. Join us again next week for another episode of the Legacy Talk podcast.